In this video, I'll share with you what are the best Canadian banks that you should be buying right now. So I'll be ranking the big 5 banks at the end of the video in the order that I would personally purchase them. And to base my decision, I'll be checking out at what is the current financial situation of the banks, but also what is their business model and what are the different financial metrics to see if the business is really undervalued. But first, you must know that the Canadian bank sector can be divided in two categories. First, you have the big 5 banks, which are TD, RBC, BNS, BMO, and CIBC. And after, you have all the smallest banks, just like the Laurentian Bank, Tangerine, and the National Bank. In this video, I'll be ranking the largest banks because they are usually more stable and have less volatility for a better return. Now, let's go with my first pick, which is the largest bank in Canada in terms of market capitalization, which is RBC with the ticker RY.TO. Indeed, with a valuation of around $180 billion, RBC currently ranks as the number 1 in Canada and the 9th largest bank in the world. It currently operates in 29 different countries, including a huge part of the Caribbean. RBC currently has more than 17 million of customers all around the world, with more than 92,000 employees and more than 1,100 different branches. As a good bank, in the third quarter of 2022, the biggest part of their revenue came from the personal and the commercial services. That means that all the different classic services that can be offered to different clients and also small companies. For example, some savings and checking accounts, but also some different loans. Also, 60% of their total revenue came from Canada and the rest was coming from the US and in the international market. Another crucial part about the bank stocks is to know what are their dividends. Right now, they are offering a dividend of about $1.28 per quarter, which represents a dividend yield of about 4% per year. But what is really interesting is that they have been able to grow this dividend years after years for decades now. However, when we take a look at the dividends, we must know if it is sustainable on the long term. And to do that, we shall look at what is the payout ratio, which is basically what are the total dividends divided by the net income. And in the case of RBC, we can see that they have a super great payout ratio of about 43%, which means that they are using about 43% of their net income to pay the dividends. Now, when we talk about the real value of a company, we can take a look at the measurement of the price to earnings ratio. The lowest the PE ratio will be, the most undervalued the stock will be. For the banking sector, the average PE ratio is about 13.5, and in the case of RBC, it is currently about 11.50. Now, to analyze the risk of the company, we can measure it by the beta. The beta is basically the measurement of the risk of a company compared to a certain market or index. And if the beta of the company is higher than 1, it means that the company will be more risky compared to the market. And obviously, if it is less than 1, it means that it is less volatile. So it's really about the fluctuation of the stock compared to the market. And for RBC, the beta is about 0.76. But even with such low volatility, they have been able to reach a massive 11+% of yearly return on a 10 years period. And in the third quarter of 2022, we've seen that RBC has had some really poor results. Obviously, it isn't the only bank that has had some bad results because of the current macroeconomic situation on the market. But we can see that in terms of revenue, they have seen a diminution compared to the third quarter of 2021 of more than 11%. And it's the same for the net income and the earnings per share that have massively diminished as well. And we've seen a slight reduction in their net profit margin with another massive reduction in their operating income. Now for the second bank, I've decided to present to you the Toronto Dominion Bank with the ticker TD.TO. This bank is slightly smaller compared to RBC in terms of market capitalization with a market cap of around 150 billion, which still makes it the second largest bank in Canada and the 12th one in the world. On its side, TD currently has more than 26 million of customers from all around the world with more than 90,000 of employees, and all of these clients and customers are spread around Canada, the US, Europe, and also Asia. TD also has more than 2,300 different branches, and just like RBC, the majority of their income is coming from the Canadian retail market, closely followed by the US market. But one interesting fact is that TD has been named as the safest bank in America. And in terms of dividends, since 1996, they have been able to grow their dividend with an annualized return of about 11.6%, which is now representing about $3.56 of dividend per quarter, or if you prefer, about 4% of dividend yield per year. And their payout ratio is also between the interval of 40 to 50%, which means that it's pretty sustainable on the long term. And for the price to earnings ratio, we can see that it's even more undervalued compared to RBC. But in terms of risk, so in terms of the beta, we see that it might fluctuate a little bit more than RBC, so it might be a little bit more risky. However, on 10 years, this bank have been able to perform super well as well with a 10.68% of average return. However, just like RBC, TD hasn't had the best result in the third quarter of 2022. However, when we compare the different indicators, we see that the results of TD were less worse compared to the ones of RBC. Now for the third bank, I've decided to go with the Nova Scotia Bank with the ticker BNS.TO. This bank is currently tied at the third position of the largest bank in Canada in terms of valuation. It is tied with BMO with a market cap of around $85 billion. And in fact, this also makes it the 25th largest bank in the world. On its side, it currently has more than 25 million of customers with about 90,000 different employees in 55 different countries all around the world. One of their big international market is actually located in South America. And on its side, NBS currently has more than 2,000 different branches. And once again, the biggest part of their income last quarter came from the Canadian banking services. And on their side, they are offering a massive $4.12 of dividends each quarter. This represents more than 5.5% of dividend yield per year. And with a super good payout ratio of about 47%, we can definitely say that it's the bank in Canada that offers the highest dividend with the lowest payout ratio. It is also super interesting knowing the fact that its P ratio is about 8, which means that it's way more undervalued on that side compared to RBC and TD. However, we can see that it has a slightly higher beta compared to the two first banks. And we can also see that the overall return in the last 10 years on average has been quite lower compared to the two first banks as well. And in terms of earnings, we can see that the Nova Scotia Bank has been able to beat the earnings in terms of revenue, net income, earnings per share, and net profit margin. However, they haven't been able to beat the predictions for the operating income and the net change in cash. For the fourth bank, I've went with the one that was tied with BNS in terms of market cap, which is the Bank of Montreal with the ticker BMO.TO. As I said earlier, this bank is currently tied at the third position in terms of market capitalization in the Canadian market, but worldwide this is currently the 24th largest bank. BMO was the first bank ever created in Canada, and it currently has more than 12 million of customers in 12 different countries. This represents more than 45,000 employees and 3,000 different branches. However, this bank has made some interesting agreements recently with some Chinese companies, which could eventually help them to expand their market to the Asian market. On their side, BMO is giving some great quarterly dividend to their holders of about $5.56, which represent an average dividend yield of about 4.30% per year. And we can see that their dividend payout ratio is quite lower compared to the other banks. So that means that they are not using too much of their net income to pay the dividends, and that means that eventually they'll be able to increase them. And on their price to earnings ratio, we can see that it's super low, about 7.60, which means that it's the most undervalued bank on that aspect. But we can see that the beta is quite higher, and it's even higher than 1, which means that it's more volatile than the index. And on a 10 years period, they have still been able to reach a massive 11% of yearly return, which makes it the second best banks on this side. And in their case, they've had some pretty bad earnings, especially in terms of net incomes, earnings per share, and operating income. However, they've still been able to be positive in the net change in cash. Finally, for the last bank, I've went with the smaller one among the 5 big banks in Canada, which is CIBC with the ticker CM.TO. With a market cap of around $55 billion, it makes it the 5th largest bank in Canada and the 45th in the world. It's actually also the second bank that was created in Canada just after BMO, and the company banking app has actually been ranked the first by JD Power customer satisfaction among Canada's largest online brokers. And this company also have an incredible dividend history to its name. Indeed, it has been consistently consistently paying dividend since 1868. Nowadays, its dividend is about $3.32 per quarter, which represent about 5.18% of dividend per year. And with a payout ratio of 46%, it means that it's also very sustainable on the long term. And CIBC also have a fair PE ratio of about 9, so this stock currently has a fair price. However, the beta is still higher than the market. And on 10 years, this bank have averaged about 8.77% of return. And in terms of earnings for the third quarter of 2022, we can see that CIBC hasn't had the best earnings as well, except for the revenue that has slightly increased of about 3.36% compared to the same period last year. On their part, Morningstar analysts have been giving a 4 stars rating to all the big Canadian banks, except RBC that however have the highest price to fair value ratio. Personally, I would put TD as the number one bank. There are many reasons to explain it, notably the fact that they have more than 26 million of customers, which is the most in all the different banks combined. They are also pretty much the best financially, and they are also well diversified. And even if it has more risk than RBC, it currently is more undervalued at the moment. For my second pick, I've long hesitated between RBC and BNS, but finally I've picked Bank of Nova Scotia. This could be a little bit surprising for some people, but personally I absolutely love the high dividends that is the highest in all the Canadian banks. I also love the power of the potential growth that they are coming with, because they actually are the most undervalued bank at the moment with BMO, and they are the most diversified bank in Canada in terms of geography. Obviously for my third pick I went with RBC, which is really the giant in Canada in terms of the banking sector. It is notably the leader in Canada in terms of retail banking sector, but it also has some great international exposure. And finally, as my personal choice, I went with BMO as my fourth pick, and I finished with CIBC because I don't really see anything really special about this particular bank. And you might know that the Canadian bank sector is pretty much one of the safest places where you can invest, especially during recession time. Well, if you want to diversify and have a little bit more risk in your portfolio and some potential higher return, you could decide to invest in real estate with some real estate investment trust. To do that, check out the video that's going to be right over here, and make sure to join the North family by subscribing to the channel for only $0.0, and I will see you soon. Peace!